Good evening, everyone, and welcome to this session. I think before we start off, I will request all of you to keep your right hand on your heart. We'll start with the ICI motto.
य एष सुप्तेषु जाग्रति य एष सुप्तेषु जाग्रति कामं 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 कामपुरुषो पुरुषो निर्विमाणः निर्विमाणः तदेव शुक्रं तदेव शुक्रब्रह्मा तद्ब्रह्मा तदेवामृतमुच्यते तस्मिन् लोकः शतः सर्वे तदूनात्यपि कश्चन एतद्वैत 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 एतद्वैत
Respected faculty for today's session, CA Saumya Sheth, the coordinator for the series, CA Rajendra Ji Nagar, CA Mayank Jain, the coordinator for today's session, CA Swati Panchal, and all the dear participants. A very, very good evening to all of you, and welcome to this yet another session on the gift series. Let me thank Saumya not only for his session. I think yesterday's wonderful session that we saw of FEMA was also organized with his help. You know, he got us the faculty. So thank you, Saumya, for that. You've always been very helpful, and today I'm sure with the income tax topic that you're going to deal with, a lot of clarity people will get on the income tax provision as far as the gift city is concerned. Yes, we are having this wonderful series. We are getting a very good reception from all the members. We have got a good response and you are getting good feedback. Just two things. One thing regarding the presentations, I think we will send the presentation in the group and also email to all the participants once we get it from the faculties. And the recording will be shared only after the end of the series. So I would urge all of you to attend it live because live discussion, live on the queries is what is the purpose of the entire series. Today we also have CA Rajendra Nagarji, who is the one of the coordinators for this series. I think he was the one who took us to Gandhinagar to experience the gift city, and basis which we thought of having this entire series. So thank you, sir, for your all the efforts that you put in for the Ahmedabad branch. Just two announcements. First and foremost, we have our elections coming in on 26th of this month, day after tomorrow. And I urge all of you to come and vote, whomsoever you want to vote, but please come and vote because voting is very important. The timing is only morning 8 o'clock till evening 6:30. So, I would urge you, all of you to come in the morning and vote. So, once you go to office, it's very difficult to come back. So make sure that we again create a history by having the highest voting this year. And yes, after this, we are also having, yesterday we did the play, the income tax play, the direct taxes and GST play that we did. And you will be very happy to know that we got a wonderful reception of the grand play Devi Prasad and Associates. And I see two characters who are there on this virtual dais. Rajanji and Swati were a part of it. And Saumya obviously was a part in drafting. It was attended by 250 plus chartered accountants in person. And also 1500 plus chartered accountants all over the country had watched it live on YouTube. So all those who are yet to watch it, don't miss out. I think it's something very, very unique, very innovative. So please do have a look at the play as well. With this, I would now request Rajendra ji to first say a few words, sir, because you have been instrumental in developing the entire series. I would request you to unmute and please share your views.
Yes, sir. Thank you, Chairman. It was a real pleasure that we could organize this 4-day session regarding the overall view of the IFSC and the gift city and the opportunity that it gives to a chartered accountant. And in turn, chartered accountant can tell their clients, their international connects, how they can do business in a different environment which is not experienced yet in India. It became IFSC being the first of its kind in India. And regarding the opportunities that a chartered accountant and other business people can have and can explore, the first two sessions that Mr. Sandeep Shah had very categorically mentioned regarding the IFSC authorities and IFSC regulations, as well as he's also told what are the opportunities that we get. And yesterday we had the IBU unit regarding the FEMA regulations, and today the income tax deductions and income tax benefits that a person or a unit gets in setting up a unit in IFSC can be clearly understood after the session. Now, I just want to add one word that it's a very golden opportunity for all the persons involved who want to do business in a different fashion and explore new opportunities and get to know how the international business is done. And with the addition of aircraft leasing and ship building, it's going to be a very, very different environment of business, which we have never experienced. In fact, I was just reading the other day that in the insurance regulatory also, the reinsurance business is also going to come in a big way in GIFT City. We have never heard of it like in India, because we have all been doing the reinsurance with the big insurers in London or in European Union or in US. But in India, a reinsurer is there present and going to help with the insurance industry also. That is going to be a very, very big, exciting opportunity for any insurance professional or for chartered accountants in helping their clients to get the best in the business. Thank you, Chairman. Thank you so much. And over to the coordinator, Swati Panchal.
Thank you, Rajendra ji. Good evening to everyone. Good evening to everyone. Energetic chairman of our branch, C. Harit Dhariwal ji, compelling coordinator Rajendra Nagar ji, distinguished members. A warm welcome to all of you in this session of income tax implications of setting up and doing business in GIFT City. It's a special series on India's first global fintech hub, GIFT City, and today is the third day. I feel extremely honored to introduce today's faculty, CA Saumya Sheth. CA Saumya Sheth is a practicing chartered accountant having professional experience of more than 15 years in the field of taxations and allied areas. His area of expertise is advising clients in the areas of corporate tax, international tax, foreign investments, foreign exchange regulations, business restructuring, joint venture arrangements, corporate law, and other regulatory laws. His specific assignments includes advising clients on the foreign exchange regulations and mergers, acquisitions, key litigations matters, and many more things. He's a regular speaker at various industry forums, including ICI, and also a regular contributor of articles to various professional journals. He is also co-author article on recent developments in FEMA published by BCA Societies Journal. He is also co-authored book on recent developments in transfer pricing in India, published by CCH, as well as his book on interest limitations provisions under Section 94B, published by Bombay Chartered Accountants Society. Prior to founding BGSS and Associates, Saumya worked for 10 years in ENY, LLP, and KPMG. With these warm words, I would like to invite CA Saumya Sheth on this virtual dais. Let's have a virtual round of applause and invite our guest.
Welcome, Saumya.
Thank you, sir. Thank you, ma'am. So I'll just share the screen.
Yes.
Is the screen visible?
Yes, it's visible.
Perfect. Okay. At the outset, thank you, Swati, for the kind introduction. Thank you, Chairman Sir Harit, for giving me an opportunity to provide my views on this topic. Thanks to the entire team of Ahmedabad branch for doing this session. It's a wonderful session. And Rajendra ji, thank you for organizing or giving this impetus to the branch that this is an upcoming area where each one of us as a chartered accountant should be aware of what all these implications are and how can we support our client in the next phase of the development of India as well as the GIFT City. So with these kind words, I will start today's session. Now, the way I have structured today's session is that I will go through this entire slide deck on different income tax implications for a unit being set up in IFSC. Now there will be several businesses which can open up or potentially open up in IFSC. So I will take through each one of them in detail. The question answers we will take at the end of the session once we are through with all the slide deck. At the end for 15-20 minutes, we will have a Q&A session. And in between, after approximately say 6:30, we'll just take, I'll have to take a water break for 2-3 minutes, so that with the kind permission of the chairman and everyone, we will take a water break and then I'll continue back. So with this, I think we will start today's session. So, friends, first and foremost, what is IFSC? So I think we have already had 2 sessions on IFSC, and most of you would be aware by and large what is IFSC. In short, full form is International Financial Services Center, regulated by Government of India under the SEZ Act. Now, under Section 18 of the SEZ Act, a specific carve out has been made for IFSC, which is for providing financial services. Now, currently, India has only one IFSC, which is located at GIFT City, Gandhinagar, and that is the sole IFSC notified till date. The point is that, or the government's intention is that going forward, they will be increasing the IFSCs after this IFSC experiment, as you could say, in GIFT City is completed or is successful. Now, what was the concept of IFSC and what was the reason? So I'll not spend too much time on it. I'll just touch upon briefly the concept of IFSC and why it was introduced in the first place. Now, friends, we are all aware that India is one of the biggest economies in the world, or growing economies in the world. The growth rate which India offers is very less as compared to the other Asian or rest of the world countries. With that perspective in mind, we have seen of late a lot of foreign investments coming into India, be it FDI, be it portfolio investments in the form of FPI, be it stock market investments, and that is the reason why we have seen a phenomenal rise in the stock market valuation or in the valuation of India as a whole. Now, with that background, everyone was aware, and even the government was aware, that India will become a place where all foreign investors would like to set up their operation or would like to get into India. So if the India is the end market where you will have most of the companies operating in India, most of the listed companies operating in India, then why not give a platform or an ecosystem to financial investors to set up their investment portfolios or to set up their basis of investment in India? The reason for doing was that they wanted to give an impetus to create an ecosystem of providing all financial services at one place. So instead of financial services being concentrated at Singapore, Cayman, or Mauritius, or Luxembourg, or any other such locations, the government had a vision that such investments should be started in India, and they are ready to provide all sort of regulatory as well as income tax, you can say, environment, so as to ensure that such financial services thrives in India, because the end market is in India. That was the sole objective. Now, what is an IFSC under FEMA? So this is just a brief background, because it is very important for all of us that when we understand this idea of IFSC, we should be exactly aware of what can be done, what cannot be done. So IFSC is treated as a non-resident under FEMA. So under the foreign exchange provisions, basically, whenever a company or a firm or a LLP or anyone entity sets up a unit in IFSC, that unit it is treated as a non-resident under FEMA. Second, IFSC unit can transact with other businesses, other units, located in IFSC, or with the foreign entities located outside India, but they can't invest or they can't transact with units or with you can say companies or entities located in India. So let's say that earlier we had this concept of DTA, domestic tariff area, in SEZ, and then SEZ area. SEZ were allowed to interact with DTA, but in IFSC that is not permissible for most of the units of IFSC. There are certain exceptions for banking companies who are allowed to give loans to Indian entities located in India, but by and large, IFSC units interact within or outside. Third point is that IFSC has to transact only in convertible foreign exchange. So they can't interact or they can't transact in INR. INR payments is allowed for administrative expenses and for payment of salaries or for other local expenses. But beyond that, they are not allowed to deal in INR from IFSC. Now, what is IFSC? International Financial Service Center, as the name suggests, is a place where government wants all financial investors, all financial companies to be present in India and provide their services. Now, as the name suggests, IFSC typically is only for providing financial services. That was the concept. Going forward, what government realized was that not all activities it is possible to be excluded from IFSC. So, for example, when we talk about financial services, first is capital market, which we all know is a financial service. Offshore banking, again financial. Offshore insurance, again financial. Leasing, if you look at it strictly speaking, it is not a financial activity because you have an asset, you are leasing that asset out to a third party. But there is a lot of aircraft leasing and shipping leasing currently which is not being undertaken from India, but the Indian companies, be it the ship owners or the aircraft owners, are taking this lease ships or aircraft from third parties who are located outside India. So government wanted to have a framework that why can't such leasing activities be also be permitted in IFSC. That's why last year they made an amendment. This year also they have expanded the amendment. So till last year only aircraft was covered. Now from the current year budget, which was presented by Finance Minister, they wish to expand this leasing also to ship leasing. The next activity is offshore asset management. So you can set up AIFs, mutual funds, portfolio management services, investment advisors. So friends, all these 5 activities, right from capital market, offshore banking, offshore insurance, leasing and offshore asset management, all of these are related to financial services, absolutely financial services, right? Now, over and above that, what the government realized is that you can't simply have only financial services, you need to have ancillary services when you are building an ecosystem. Now, what are these ancillary services? So basically legal, accounting, audit, research, analysis, fund accounting, risk management, etc. Now, all these ancillary services, so as to say, they support the main services of providing financial services. So if you don't have legal services, okay, contracts cannot be reviewed. If contracts cannot be reviewed, then it will not be possible for any entity to set up any operation in IFSC. Same for say a chartered accountant, because the CA would be providing various services, be it tax advisory services, be it management advisory services, be it accounting services. Okay. Now all these services can be provided only if that CA is sitting there in IFSC. Otherwise, it does not make sense to have that ecosystem, to have only financial companies but no support system. So to overcome that, GIFT City relaxed the criteria of ancillary services, and now all ancillary services are also allowed to set up their operations in IFSC. Now, what was the circular? So the background is there are 2 circulars which were issued by IFSC, and all these circulars are now issued by IFSC-A, which is International Financial Services Center Authority, which was constituted under the IFSC-A Act 2019 by the Government of India. Now, under that Act, all the powers to regulate whatever IFCs are there in India is with only one authority, which is the IFSC. Now, because that IFSC-A has that authority, it also overrides RBI, IRDA, SEBI, or any other regulator for that matter. Because for regulating all these services, it is practically not possible that you have different regulators for each of the services or for each of the type of business. So to overcome that, government has vested all the powers relating to management of IFSC with one authority, which is known as IFSC-A, International Financial Services Center Authority. Now, they have issued 2 circulars. One circular was issued dated 10th Feb 2021. Another was issued dated 10 June 2021. Both the circulars provided that what all are permissible activities, ancillary activities which you can do in IFSC. Now, the reason why we are stressing more on this kind of activities is that when we are advising our clients, we need to understand that what kind of services will be allowed or will be permissible in IFSC. Basis that we can make recommendation to our clients if they want to shift their operations to IFSC. Without knowing that, it will be premature for us to tell our client or to tell anyone or to suggest anyone that they can open up an IFSC only basis the tax benefit. So what all services are permissible? Legal services are permissible, compliance, secretarial, auditing, accounting, bookkeeping, taxation service, professional management consultancy service, administration service, asset management support service, trusteeship services, or any other services as will be approved by IFSCA from time to time. If you look at the broad nature of ancillary services which have been allowed to be operated from IFSC, they are more or less related to support function, be it legal, be it compliance, be it audit, be it tax, be it management consultancy, administration, or any other. So basically, the outlook or the I would say the feedback of the government was that without ancillary services, it's not possible to function. So please allow ancillary services or the support system to be operated in IFSC. Hence, this relaxation. Now, entities can set up unit in IFSC either by way of setting up a new branch of an existing company or an existing entity, or they can set up even a fresh entity in IFSC. So today, let's give you an example that ABC Private Limited is into the business of providing financial advisory services. It can set up a unit in IFSC either by way of incorporating a new company, say ABC IFSC Limited, or the second option is that what it can do, it can open up a unit in IFSC which will be a branch of the Indian company. So both these options are currently available for ABC Private Limited to set up their operations in IFSC. Now, so from a tax perspective, once you are incorporating a company, all the provisions of Companies Act or Income Tax Act relating to new company are applicable. And there are no specific exemptions as far as incorporation of a company is concerned or incorporation of an entity in IFSC is concerned. So if it's a new company, new normal income tax provisions will apply. If it's a branch of an existing company, okay, or existing partnership or an LLP, then what will happen again? From a tax perspective, we are neutral. It does not make any difference. If you are setting up of a new unit, then or a new company, new legal entity, from India, it will be treated as ODI overseas direct investment, because as we discussed earlier, that for the purposes of FEMA, this any entity located in IFSC is treated as non-resident. So once it is treated as a non-resident, then any payment which you make has to be under the ODI route or by filling the ODI format. So you have to fill form ODI, you have to take approvals, 400% of the net worth for individuals. You have an LRS limit. But if you are an individual, if you have to set up a unit in IFSC, it can't be set up under the LRS route. There is a clear-cut prohibition which RBI has prescribed to ensure that resident Indians are not able to operate or use the LRS for incorporating a company in IFSC. So having said that, once we are aware that what all ancillary services can be provided, how they can be provided, what is the investment, how do we make the investment, what is the practical situation there, and basis that you can determine whether ancillary services can be provided or not, and if yes, what will be the tax benefits. Now, before I take up this topic of tax benefits, one important aspect is with regard to residential status. And why it is important is because your residential status will determine whether a particular income is taxable or not. Now, what is the residential status as per FEMA? So under FEMA, any unit located in IFSC is considered as person resident outside India under Foreign Exchange Management IFSC Regulation 2015. So FEMA is very clear, no ifs, no buts, no number of days criteria, nothing doing. If you have set up a unit in IFSC, that means you are deeming it to be a person resident outside India. And once you are deemed to be a person resident outside India, then there is no requirement to inform RBI for each and every investment subsequently being made by that company. So once a unit is set up in IFSC, after that, Ideally, once you say that this is a unit from FEMA, it is a non-resident. Now come to the income tax. Income tax does not have any carve out for residential status of such undertakings or such units. Under the Income Tax Act, the unit, whatever is the, wherever it is located in IFSC, that unit is treated as a normal unit and there is no relaxation under Section 6 for determining the residential status. So whether they are set up as a separate entity, be it an LLP or company or any other format, they will be considered as a resident in India. Once they are set up a unit in IFSC, they will be considered to be a resident in India, and their global income will be taxable in India. And if it is set up as a branch, then only the branch income will be taxable in India as per the applicable provisions. So one thing we need to be very clear and understanding is that we need to understand that whenever a residential status is set up or whenever unit is set up in IFSC, their residential status will not change. It will remain as it is, that is a person resident in India. Or now for individuals, you have category or resident but not ordinary resident, non-resident, resident and ordinary resident. For companies or LLPs or partners, we have only simple status that either they are resident or non-resident. We don't have any other ordinary or not ordinary resident. But from the purposes of IFSC, if you are opening a unit in IFSC, it's very clear. They are considered to be a resident in India and their global income per se is taxable in India. Having said that, then we'll come on to the next topic, which is the tax benefits for unit in IFSC. Now, friends, this is, I would say, one of the most important and crucial area of this entire presentation today. What are the tax benefits which are eligible for setting up of unit in IFSC? Because most of our clients or most of our friends or colleagues, this is the prime question which they will ask, that okay, everyone is coming to IFSC. A, can we set up? B, what are the benefits? So this is where I will spend maximum time on understanding the benefits, because there are certain areas in terms of specific industries, AIF, then aircraft leasing, ship leasing, so on and so forth, portfolio management. I would not like to go into detail for each of these activities. We will definitely go, but most of us will be covered under this slide deck. So first and foremost, whenever a person sets up a unit in IFSC, it can either be a unit in IFSC, or if it's a bank, it can set up an offshore banking unit. So these are the two options which are available for setting up a unit in IFSC. Now, once that IFSC is set up, then what is the benefit? The benefit is that, and first is, who is an eligible SSE? So either a scheduled bank or a bank incorporated by or under any other law outside India having an offshore banking unit in an SEZ. So first is, you should be a bank, a scheduled bank specifically, or you should be a bank incorporated outside India, Standard Charter, BNP Paribas, so on and so forth. They are a bank incorporated outside India under any other law outside India. The first is scheduled bank. Okay, so if you have a scheduled bank or if you have a incorporated outside India and you have an offshore banking unit, then you can set up or you are an eligible SSC as far as claiming deduction or ETLA is concerned. The second type of SSC is a person who has set up a unit in IFSC. So only these two categories are eligible SSC. It is unlike ATIA, 10AA. It does not say that all companies or all people who are engaging into services or who are earning income set up in SEZ for 10AA, okay, and they are earning income, they are eligible as long as it's from a business operations. No such conditions is mentioned here for claiming deduction or ETLA. The only condition is it either has to be scheduled bank or bank incorporated under any other law for the time being in force and having an offshore banking unit in SEZ or unit of an IFSC. So these are the two persons who are eligible to set up a unit in IFSC. Now, what is the quantum of deduction? Once you set up the unit or once you set up an undertaking, the next option is that how much deduction you will get. So it has been laid down that for an offshore banking unit, 100% of the income for first 5 consecutive assessment years, and for the balance 5 years, 50%. Now, there is a catch here. What do they say? They say that 100% income of the offshore banking unit. So whenever you have an eligible SSC, that may be a scheduled bank or a bank corporate outside India or Union FSC, they can set up. Now, what is the deduction for offshore banking? 100% for first 5 years, beginning from the date when you got the permission, and for the remaining 5 years, 50%. Now, offshore banking, it is very clear that from the date you get a setup or permission from RBI or IFSCA, that is International Financial Services Center Authority. Once you get a permission from either of them, from that day, for 5 years, you will get 100%, and for remaining 5 years, you will get 50% deduction. If you are a unit which is set up in IFSC, there are even more benefits. So 100% of income for any 10 out of first 15 years is eligible for deduction. Okay, now what do we mean by 10 years? Sorry, 10 out of 15 years. Now, unlike offshore banking unit or OBU, let's say, if you are setting up a normal unit in IFSC, okay, then whatever is the income which you earn, 100% of that income is eligible for deduction and TLA for consecutive 10 assessment years, beginning from the year in which you want to claim deduction. So the option is at the SSC's end. It is available to the SSC that in, let's say today, the unit has been set up in FSC and the first order will come next year. In that situation, SSC can take a view that I want to claim deduction in 10 assessment years, consecutive assessment years, beginning from next year. So first and foremost, what is the quantum of deduction which is allowed? The third part is that on which income you are allowed a deduction. So for offshore banking unit, entire income is allowed as a deduction, and for a unit which is in IFSC, your entire business income is allowed as a deduction, and gains from sale of ship or aircraft is allowed as a deduction. So friends, this is very important because we need to understand that what is the quantum and what is the income. Any businessman, when he takes a decision that whether to move to IFSC, whether to move to gift city, there will be several considerations. So we need to be aware that whether this is permissible and whether it is in the interest of the client to move to IFSC. Now friends, if you look at the distinction between OBU, offshore banking unit, and a unit in IFSC, what an IFSC unit says that you get a deduction in any 10 out of 15 years. So SSC can choose that not this year, year 2, year 3, year 4, when actually the business starts picking up, I will take the benefit, or I will say that I want to claim deduction from this year 4, or year 3, or year 5. So that option is available to SSC. So that thing is very clear. So one thing is very clear that whatever is a deduction, you get it in 10 out of 15 years, and that is at the option of the SSC. And this is only for unit of an IFSC. There are 2 more normal conditions, okay, which is obtaining a CA certificate, and you need to obtain a permission from IFSC. Both of this needs to be filed or needs to be submitted to the authority. So procedural conditions, nothing specific. Now, before I go on this MAT or AMT applicability, there are 2-3 aspects in relation to this ATLA. First is that what does the section say? Section says that as far as MAT is concerned, so 115 JB, there is a relaxation, and for AMT, alternate minimum tax, which is applicable to LLPs or partnership firms, that if these provisions are applicable, and if you are a unit located in IFSC, then the MAT rate or the AMT rate gets reduced to 9% of the book profit. MAT rate same as for other provisions. And if you are opting for the new regime, which is 115BAA, okay, then MAT is not applicable. Every one of us is aware, right, that most of the companies have now opted to move into the new regime, which is 15BAA, where MAT does not apply. Even in those situations, if you are a unit located in IFSC, it is beneficial. Why? Because you can claim a deduction at 80LA. If you are covered under the new regime, there are hardly any deduction is available. One is 80JCAA, another is 80LA. So apart from this, you will not be able to get a deduction, and hence it makes more sense for most of the companies, okay, to move to IFSC or to set up a unit in IFSC. It is more than relevant. Now, friends, one more aspect in relation to the quantum of deduction is that if you look at the subsection 1 of 80LA speaks about that whenever a bank, a scheduled bank or a bank incorporated outside India sets up an offshore banking unit in an SEZ, then he shall be allowed a deduction as prescribed under subsection 2. This is what is mentioned in subsection 1. And 1A similarly talks about a unit set up in IFSC. It can get a deduction of income referred to in subsection 2. So by and large, it is very similar. Now, if we go to subsection 2, what does subsection 2 cover? Subsection 2 covers subsection A, subclause A. Subclause A covers that any income of offshore banking unit. So basically, just to take an example, let's say you have a Standard Chartered Bank. Standard Chartered Bank has set up an OBU or offshore banking unit in IFSC. Once that unit is set up, as per the law, entire income belonging to that IFSC, which is located in say Gift City and Gandhinagar, entire income of OBU is exempt from tax or is subject to deduction under 80LA. So you don't pay effectively any tax on such income. That is point number 1. So offshore income not taxable. Second point, clause B. Clause B says that whenever you have received an offshore banking unit or whenever a person receives any income which is in the nature, okay, of or entering into a transaction with an IFSC, so let's say SCB, you can say Gandhinagar, or FCB Gift City, IFSC, located in IFSC. It enters into a business with any other company which is also located in IFSC. So it's IFSC to IFSC kind of, okay, that Mr. A or SCB Bank is providing loan facility or any other facility to any other company located in IFSC. So you are providing services to another IFSC and earning income therefrom, or even if you are not providing services, you are entering or you are providing services to the developer, operator, or a person who is managing the SEZ or the IFSC. So basically, whenever you are giving any loan, whenever let's say you are providing or you are providing certain services, subclause B says that that income is exempt from tax and it is not taxable. Subclause C talks about any unit, any income, any business income of a unit located in IFSC. So one thing is very clear that if you are in IFSC, whatever is the amount is the deduction. Okay. If you are set up in IFSC, whatever is the business income of a unit, on that you will be eligible to claim a deduction. Now here there is some anomaly, I would say, in the provision, because if you look at it, clause A talks about all income of OBI or offshore banking units, and clause B talks about income of a banking unit, okay, with transactions undertaken with SEZ unit or internally or with third parties. So I would say developers of the SEZ, the person who is developing, operating and maintaining an SEZ. Now, if I take that view that offshore banking unit, all income of offshore banking unit is exempt from tax, then there is no need for clause B. Because you have two units which can be set up in IFSC. One is offshore banking, second is a unit, a simple unit in IFSC. Now, for simple unit in IFSC, you have clause C which says that you can set up any number of units irrespective of anything. And as far as banking are concerned, offshore banking, okay. So for offshore banking, you have this specific income which is exempt, that any income offshore banking is exempt. But unit, you only need to have business income. and capital gains. Again, capital gains was only from sale of ship or aircraft. So you have gains arising from other than sale of ship or aircraft, it is taxable. So if we take a view that entire income of OBI is covered under clause A, entire income of unit is covered under clause C, then clause B becomes redundant. Now, what is the purpose behind introduction of clause B? Maybe we can discuss and debate. But one of the interpretation which could be forthcoming is that if a bank has set up an operations in IFSC and is also interacting with other units in IFSC outside the IFSC, may be possible to take a view that that should be also eligible for deduction under ETLA, even if it's not an income of OBI. Having said that, it's an aggressive interpretation, but maybe a clarification from CBDT would be more than welcome, so that everyone is aware that what kind of activities or what kind of income will be eligible for deduction under ETLA and what will not be allowed as a deduction under ETLA. Now, there are certain issues which I would like to briefly touch upon while completing this topic on ETLA, because friends, this is, as I said, most important topic of the entire discussions on GIFT City. Remaining are those, which are related to fund portfolio management, but this is something where each one of us will relate to. Now, unlike section 10AA, which all of us are aware, even 10AA, 10A, 10B, 80IA are correct, there was a common proposition which says that you cannot set up a unit, okay, by splitting up or reconstruction. So there were formative conditions which were prescribed under section 10AA, 10A, 10B, okay, as well as 80IA provisions. So those conditions were prescribed. Now, if you take up a case of IFSC, okay, for IFSC, there are no such conditions which are prescribed. So technically, if you close down, let's say you are into an operations, you close down the operations and you move to IFSC, allowed, no problem. Deduction, allowed, no problem. Now, no splitting up, no reconstruction is disallowed. So even if you are setting up a business by way of splitting up or reconstruction, it is still permissible. Second, that there are conditions in 10AA that the unit should not be formed by transfer of new business or old business or old plant and machinery. Then there are certain relaxations that if it's an imported machinery, if it has not been used in India or depreciation has been claimed, okay, under the 20%. So whatever are all those kind of, I would say, units, all these formative conditions which were prescribed under section 10AA, they are not prescribed under ETLA. So you can shift your business from DTA or domestic territory or normal area to IFSC without any reasons. It can be stop and play. So that is practically, it seems to be possible because the law does not have any specific carve out to say that this definition, I mean, so there is no specifically carve out laid down under ETLA, so you can definitely change or transfer your business or splitting up reconstruction of existing business is allowed to set up a unit in IFSC, and once you do that, you still get deduction under section ETLA. One example I have taken, friends, for a better clarity, that let's say ABC Limited is providing foreign exchange services to its various clients located outside India. Now, the question is, can he relocate his existing business in IFSC and claim 100% of deduction for providing this service under ETLA? So, friends, if you look at it, what does the section say, or what is the background to this? That Mr. ABC is providing foreign exchange advisory services to clients outside. So, whatever is the foreign exchange services ABC Limited is providing, currently, let's say it's providing in DTA. Tomorrow, it can shift its business to IFSC, start providing services from IFSC, okay, and whatever income is generating, he can get 100% deduction. So basically, there is a tax arbitrage available if you shift your business from DTA to IFSC. subject to fulfillment of certain conditions. So if you have set up a unit by splitting up, transfer, reconstitution, it is not eligible. It is still eligible for deduction to 80 LA because those are not a criteria for 80 LA. Moving forward, in case of amalgamation demerger, section 80 specifically and 10AA specifically provides that for amalgamating company or demerged company, as the case may be, is not allowed as deduction. So one thing is very clear, that what is permissible, what is not permissible as far as amalgamation is concerned. Now 10AA, you had a prohibition which says that if a company is into amalgamation or a demerger, amalgamating or demerged company will not be eligible, and you have to ignore as if that amalgamation or demerger did not take place, and it's the benefit is available in the hands of the resulting or amalgamated company. Now 80LA again is silent on this front. So if there is a case of an amalgamation or a case of a demerger, it does not mean that you will lose on the benefits. Ideally, the benefit should continue. So that is another clarity, I would say, which has been brought by the legislature, thanks to them, that this amalgamation demerger, they have remained silent, and sometimes silence is the best policy. Second, 80IA subsection 8 and 10 talks about transactions between group entities or companies. So whenever there is any transaction between any two IFSC unit, or both are related, or between an IFSC unit or its a parent company which is located outside the IFSC, okay, then under the law, what it prescribes is that both these transactions have to be taken and undertaken at a market rate. Now, if it has not been undertaken at the market rate, then EOI also has the power to look behind the transactions and establish a connection. Once that connection is, I would say, the moment the transactions between resident and non-resident, or intersect between two units or with third parties, okay, that has to be under market rate under erstwhile 80IA, 10AA, and all those provisions. Under IFSC, section 80LA does not prescribe any such conditions, that both these transactions has to be at arm's length. But from a practical standpoint, we would always recommend that whenever you are transacting intersect between within the group or within the company, you have, let's say, a plant in Halol and you have another plant which is located in this SEZ, okay, then better that both of them interact. Once they interact, at that point of time, so based on that interaction, we need to ensure that it has to be at a market rate. But law does not prohibit you currently if it is not at a market rate. Third, under the law, there is a depreciation adjustment. So even if you are coming by Bombay, you three job, correct? Sorry, the moment this depreciation, whenever you are entering into a transaction, okay, and you are claiming a deduction to 10AA, what the law says that it is deemed that you are eligible for depreciation. So once you move out of 10AA, the WDV will be calculated on a notional basis, assuming that you had claimed depreciation right from day one. For 80LA, so even if you are claiming deduction under 80LA, no such express provision is mentioned. So that means you can claim a deduction under 80LA and depreciation can be separately. So this adjustment of depreciation is not there for 80LA. So friends, if you look at it, it becomes very easy and very simple to set up a unit in IFSC, because A, you don't have any formative conditions to be fulfilled. When I say formative conditions, that means that formative, what kind of sponsor should be there, what kind of ownership should be there, okay, what kind of you can say continuing activities can be taken, whether amalgamation is possible, what kind of transactions can be taken between group companies, without group companies, depreciation adjustment, so on and so forth. So we need to be very clear that when we are advising our clients, that if you are moving from existing unit to an IFSC unit, it is always beneficial in the best interest of the company. Now, one more aspect which we also need to keep in mind is that not all activities can be permitted in IFSC. IFSC permits only certain type of activities, and when we say certain type of activities are permitted, it also means that ancillary services. So if our clients are engaged into ancillary services or are engaged into, say, let's say chartered accountancy service, company secretarial service, risk management service. So if our clients or our firms or our colleagues, okay, they are engaged into this kind of activities, then it is possible to shift their operations from normal to IFSC and claim a benefit under Section 80 LA. But one thing needs to be sure, that whenever you are transacting, you cannot transact with Indian companies. You have to transact either locally within IFSC or with overseas non-residents. So, and consideration also has to be in foreign currency. So if you are able to fulfill it, then you can definitely move from your normal undertaking or from a normal business to IFSC. So that is definitely allowed. Now, friends, what I would just go through is that there would be various types of non-resident investors who would be dealing or investing in IFSC. Okay, so what are the tax benefits available to the non-resident investor? So now we are going a step above what we discussed. Currently, we discussed that whenever a unit is being set up in IFSC, or if there is a company, okay, so be it a company, be it an offshore banking unit or a unit in IFSC, what all benefits are available? So we have gone through all that. Now we will go on to the tax exemptions. What tax exemptions are eligible to the non-resident investor who is dealing in IFSC? So friends, we have listed a snapshot or a summary, so as to say, of different tax exemptions available to non-residents across, I would say, different categories. Now, what are the tax benefit available? So let's take one by one. First is for deposit. First and foremost is deposit. So the non-resident investor places a deposit, okay, and earns interest income from that. Now he places a deposit definitely an offshore banking unit or OBU. Under the law, what does income tax law provide? Section 1015(8) that interest income earned on deposits made by a non-resident or a person who is not ordinary resident, they have even gone a step further, then that income will be exempt from tax. So if a deposit has, let's say, placed NRO deposits, NRE deposits, or different kind of deposits with the NR bank, and he wants to sell whatever is the land which he has bought, okay, or whatever is the interest income which has been earned by non-resident, on that there is no tax and it is exempt. So this is as far as deposits are concerned. Second is with regards to loan. So any income payable by FC unit on money borrowed from a non-resident is also exempt from tax and not subject to any TDS. So to give an example, let's say A Limited is a foreign company. Foreign company gives a loan to the IFSC. So whenever there is any loan and whenever there is any interest income on money borrowed by IFSC unit from non-resident, again that is exempt from tax. Third, non-deliverable forward contracts. So any income which is arising or accruing or received to a non-resident as a result of non-deliverable forward contracts entered with OBU of IFSC is exempt from tax, subject to fulfillment of certain conditions. Section 10. So if you are transferring a non-deliverable forward contracts, that capital gains arising therefrom is not subjected to tax. Fourth, long-term bonds and rupee denominated bonds listed on IFSC. So whatever is the interest income on long-term bonds on rupee denominated bonds which are listed on IFSC, they are taxable at the rate of 4% under section 115A1 2AB read with section 194C. So these are different type of benefits which are available to a person above the AIF, okay, or above the IFSC. So basically it means that a person is technically not in IFSC, but let's say these are the exemptions which are available to non-resident investor, a level above the IFSC. So what the government has clarified is that not only at the IFSC level we want a clarity, but also a level up than that, which is at the investor level also we need a absolute clarity. Second, transfer of specified securities listed on FSA exchange. So let's say a non-resident is holding certain shares of a listed company. So once this a non-resident investor is holding shares or is holding specified securities which are listed on IFSC exchange, then capital gain arising on this sale of bonds, GDRs, rupee denominated bonds of Indian company or derivatives or notified securities, which is listed on IFSC and consideration is in foreign currency, it is exempt, not taxable. Now, what all specified securities are there? They are bonds, they are GDR, they are foreign currency denominated bonds, rupee denominated bond of an Indian company, derivative, unit of mutual funds, business trust, EIF units, and foreign currency denominated equity shares of a company. So not Indian equity shares, but foreign equity shares. So if you have all this kind of income, you are a non-resident, if you have such kind of income, then it is exempt from tax. What is important? The security have to be listed on IFSC, then or for bonds or GDR or rupee denominated bond, then it is eligible for deduction exemption under income tax. Last, category 3 AIF. Okay, so a non-resident shareholder or a unit holder has invested in category 3 AIF, which is a specified fund laid down under section 10(4)(d). Now, section 10(4)(d) talks about it lays down various conditions which you need to fulfill. So let's assume that you are fulfilling those conditions, and we'll come to those conditions in as we go on. But right now we are at the investor level. That what happens at the investor level? So if you are a non-resident investor of a category 3 AIF, which is situated in IFSC, transfer of units of category 3 in IFSC fulfilling certain conditions is exempt from tax, and any other income receivable from category 3 AIF by the investor is also exempt from tax. So both of this is exempt from tax. And the last is for category 1 or 2. So if you are a non-resident investor holding category 1 or 2 AIF, okay, so you are a unit holder of category 1 or 2 AIF in IFSC, and you are earning the business income, okay, which you have received from the category 1 or 2 AIF, then that income is exempt from tax and is not taxable in the hands of the non-resident investor. So with this, friends, I'll pause for a couple of minutes for a water break. I'll just drink water, and we'll again assemble in 2 minutes. Yes, friends. Sorry. Okay. So we proceed further. So with this background, that now we are aware that what kind of activities is allowed and what kind of businesses. And the second is what are the benefits available to a non-resident investor who is dealing in IFSC. Now comes the most important aspect where the government of India has focused its maximum attention on is setting up an AIF or an alternative investment fund in IFSC. Now, at the first shot, friends, I am aware that all this is pretty jumbled up, but this is a typical structure of an AIF. So I will try to take it a little bit slowly so that all of us are aligned that what is the structure and how does an AIF operate. So first and foremost, what you need to do is that in a case of an AIF, there is a trust. Most of the AIFs are set up as a trust, alternative investment fund. So you will have an investor. Investor will have a contribution agreement with AIF trust. Investor will also make investments in offshore feeder, which will be the feeder company who will be investing in AIF, and they can also make investment in portfolio investment. Okay, so offshore feeder and contributor investors will contribute in the AIF. AIF will in turn enter into an agreement with investment manager for managing the proceeds of the fund or proceeds of the trust. So you will have investment manager. Okay. Thereafter, investment manager will provide management services of managing this entire portfolio of trust. There is a mandatory commitment also given by the manager to the trust, and thereafter the trust will make the investments, portfolio investments. Portfolio investments can be made in three cases in the example before us. First, it can be either offshore to a foreign entity. Second, it can be onshore, so on stock exchanges or on the securities listed on the stock exchange in IFSC. I think yesterday and day before yesterday, Sandeep Bhai had taken this session on stock exchange in IFSC, and tomorrow we have a session on specifically only on stock exchanges which are operating in IFSC. But just to give a background, those stock exchanges, INX, they are operating 22 hours a day. So in fact, they are covering most of the world markets, okay, right from say Singapore and ending up to where US is ending. So that the entire world market is being covered and targeted. So if any security is listed on INX or that IFSC stock exchange, that AIF trust can make investment in those exchanges. It can make investment offshore, or they can also make investment in onshore, that is in Indian listed securities or listed companies. Similarly, you will also have a parallel structure where you will have a domestic AIF, which is again set up as a trust by investors who will be based out of India. And again, you will have an investment manager providing management services, entering into a contribution agreement, and receiving a mandatory commitment from the manager. So this is a broad structure of how an AIF typically can be set up in IFSC. There can be many other combinations, but this is a typical structure which you will find. Now, what is the taxability of this kind of investment funds? Now, broadly, friends, under the income tax law, you have three categories of AIFs: category 1, category 2, and category 3. Now, in short, I can say Cat 1, Cat 2, and Cat 3. Now, for Cat 1 and Cat 2, what does the law say? That they are passed through. When I say pass through, that means that for all Cat 1 and Cat 2 funds, whenever they are receiving any income other than business income, then it is not taxable in the hands of the Cat 1 or Cat 2 AIF, but it is taxable in the hands of the investors. So in other words, it's a pass-through entity, it's a transparent entity, not taxable at the AIF level or at the fund level, but at the investor level. This benefit or this treatment is provided under Section 15UB. Now, if it's a business income, so let's say if Cat 1 and Cat 2 are earning business income, then they are taxable at the fund level itself, and they are not taxable at the they are not taxable at the investor level. So basically, you have two options. Option one, business income. Option two, other than business income. If it's a business income, it is taxed at the fund level, not at the investor level. If it is other than business income, which generally is the case, because you will have interest income, you will have capital gains, you will have dividend income. All those are not taxable in the hands of Cat 1 and Cat 2, but they are taxable at the investor level. Now, if you have a Cat 1 or a Cat 2 AIF, which is set up in IFSC, and you are earning business income, because other than business income, anyways is exempt whether you are in IFSC or not in IFSC. But if you are a Cat 1 or a Cat 2 IFSC earning business income set up in IFSC, you can claim a deduction of business income under 80LA. So what will happen that this income, business income, which you have claimed deduction under 80LA, that will not be taxable at the fund level, but it will be taxable at the end of the unit holders. Now, so this is broadly, friends, the treatment which is allowed or which is there for Cat 1 and Cat 2 AIFs located in IFSC. Third category is Cat 3 AIF set up in IFSC. Now, Cat 3 AIF typically can again have different income streams, interest, dividend, capital gains, business income. Now, what happens is, as we saw earlier, that if you are setting up of a unit in IFSC, only your business income is exempt. Now, currently, if you have an AIF, okay, Cat 3 AIF, you have set up operations in IFSC under the provisions of Income Tax Act. What it says that this Cat 3 AIF needs to obtain registration from SEBI as a foreign portfolio investor. Now, if you are a FPI or a foreign portfolio investor, then by default, whatever investment you are making will be a capital gains, it will not be your business income. And if, as it is capital gains, it is not covered or it is not eligible for deduction under 80LA. Only capital gains which are in the nature of sale of aircraft or ships is covered as a deduction under 80LA. Rest of them are not covered under section 80LA. So if you are a Cat 3 IFS set up in IFSC, Cat 3 AIF, and you are receiving income in the nature of capital gains from your investment made, it is not eligible for deduction under section 80LA. So this distinction between Cat 1, Cat 2, or let's say Cat 1, Cat 2 on one hand, Cat 3 on the other hand, we need to be well aware and we need to keep that in mind. Now, what kind of income of Cat 3 is exempt under section 10(4)(d)? So if you are a Cat 3 AIF, okay, and you are earning certain specified income and you are a certain specified fund, then your entire income is exempt from tax. Okay, so what kind of income is exempt from tax? That is what we'll see in this slide. So income from transfer of following capital assets which are referred in section 47 subclause 7 AB. So if you have income arising from transfer of these assets and it is the securities are listed on a recognized stock exchange in an IFSC, and the third condition is that the amount is paid or payable in convertible foreign exchange. So if you have these three conditions being fulfilled, specified assets, securities laid down in this slide deck, second on the recognized stock exchange located in IFSC, and third convertible foreign exchange, consideration is paid payable in convertible foreign exchange. If these three conditions are satisfied, then income of Cat 3 AIF is exempt under income is exempt under section 10(4)(d). Now, what kind of securities are covered? So you have bonds, you have GDRs, global depository receipts referred in section 15AC. You have rupee denominated bond of Indian company. You have derivatives. You have foreign currency denominated bond FCCBs, as we commonly say. You have mutual fund units. You have business trust units. You have foreign currency denominated equity share of a company and unit of AIF. So if you have invested in all of this and foreign currency consideration is payable on stock exchange, then its income is exempt. Second, income arising from transfer of securities other than of a shares in a company resident in India. So let's say you are an AIF, you have invested in shares of Tesla. In that case, it's income arising from a transfer of securities other than shares of a company resident in India, covered under 1040 exempt. Third, income from securities issued by a non-resident, not being a PF non-resident in India, and such income does not accrue or arise in India. So, non-resident has issued foreign securities, and the income is does not accruing or arising in India, but it is received in India. Because mind you, friends, as we saw earlier, IFSC is not deemed to be non-resident under income tax. So you have a bank account opened in India. So whatever transactions that AIF is undertaking, money will come to the foreign Indian bank account located in IFSC. So by section 6, if you look at it, and section 4, if you look at it, amount is received in India. Amount, once it is received in India, ideally all income is taxable in India, wherever you have received in India. Now in this case, because government wants to set up this ecosystem of AIF, what it is saying that AIF, if they have received any income of a foreign security, of a security issued outside India, and consideration also in foreign currency, then the income will not be taxable in India because it does not accrue or arise in India. Third, income from a securitization trust, which is chargeable under the head PGBP, profit from business profession. So if you have income from securitization trust, again that is not taxable. Now, one important factor which we need to keep in mind is that this exemption is only available with respect to income which is attributable to the units held by non-resident. So in other words, let's say that if you have a AIF where 90% of the unit holders are non-residents, okay, and 10% are residents, or 10% are local other than non-residents, let's say. In that situation, this exemption is available only to the extent of 90% of the income of AIF. For remaining 10%, it is taxable. Now, how do you compute this 90%, 10%? Okay, principally is what I explained. The manner of computation is laid down in detail in Rule 21AI, which prescribes the method that if a non-resident is holding X percentage, Y percentage, how will you determine that and how will you determine the tax exemption amount? Now, similarly, if such a specified fund can also be an investment division of an offshore banking unit, for that, currently the mechanism is not been prescribed like Rule 21AI has been prescribed. So that method of prescription for offshore banking unit is not prescribed. But for other than offshore banking unit, that is category 3 AIF, Rule 21A has been prescribed, which says that to the extent you have non-resident shareholders, unit holders, the income will be exempt. So in principle, let's say you can have two situations. Situation 1, where 100% of your unit holders are non-residents, entire income can be exempt. Situation 2, you have proportionate non-resident shareholders, then they are proportionate to the extent you have non-resident shareholders, then proportional income will be exempt because that belongs to the non-resident shareholders. Now the idea is that why such a provision has been created is to give a parity with as far as other financial services center are concerned, be it Singapore or be it Mauritius, where you don't have a capital gains tax. So the government says that if you are a non-resident investor, please invest in a AIF, Cat 3 AIF, which is incorporated in IFSC, we will not tax you. Neither will we tax investment fund, nor will we tax the investors. We saw the tax treatment at the end of the investor earlier. Similarly, for fund also is covered here. So that is the logic, or that is the purpose of this rationale behind these provisions. Now, what is definition of specified fund under 1040? It has to be a fund established or incorporated in India in the form of a trust or a company or an LLP or a body corporate, fulfilling following 3 conditions. A, Cat 3 AIF, it has been granted certificate of registration as Cat 3 AIF and regulated by SEBI or IFSC authority located in IFSC, and all units must be held by non-residents except units held by sponsor or management. So that exception which we saw in the preceding slide is with regards to sponsor or management, Okay, who would be owning the residential sets, residential units? Because by definition, under 1040, most of the investors has to be non-resident. So you can't have a resident investor like say me, for example, investing in a Cat 3 AIF located in IFSC. That is not allowed. That is not permissible. Second option in case of specified fund is the offshore banking units investment division. So you have an investment division of an offshore banking unit granted registration as a Cat 1 FPI under the SEBI regulations. They have commenced operation before 31st March 2024 and they fulfill such other conditions relating to maintenance of separate accounts for investment division as well prescribed. So if all these three conditions are satisfied, then you are also eligible for deduction or for exemption under section 10(4)(d). Now, other than 10(4)(d), okay, if you are a Cat 3 AIF located in IFSC, then your income will be subjected to following preferential tax rates. First, income received in respect of securities other than those referred to in 115EB. If you have dividend income, 10%. If you have interest income under 194LD, 5%. Any other interest income, 10%. For short-term capital gains, 10%. Long-term, 10%. Short-term, 20%. Now, friends, again, these preferential rates are applicable only to the extent that your income is attributable to non-resident unit holders. So, if your income of AIF, Cat 3 AIF, if you are 100% owned by non-resident investors, okay, then the income or the taxability of the fund will be divided into two parts for Cat 3 AIF. Part 1 will be those securities which are specified under section 47 and laid down in 10(4)(d). If they are covered, then the entire income is exempt, not taxable. Second category is those who are not covered under Cat 10(4)(d), and there are other securities, as you can see on the screens, dividend, interest, or long-term, short-term capital gains. Then they are taxed at the rates prescribed in the act, which is there on your screen. So, friends, these are the two bifurcations we need to clearly keep in mind, that what is the nature of income of Cat 3 AIF to determine the taxability and whether in what situation it will be taxable and what. Also, going back just to do a recap, Cat 1 and Cat 2 is exempt at all levels, be it in IFSC, be it outside IFSC. So that deduction or exemption does not apply. Business income of Cat 1 and Cat 2, as we discussed earlier, as you saw earlier, that is for Cat 1 and Cat 2, business income is ideally taxable at an IFSC level as well as outside the IFSC level. But if it's in IFSC, you can claim a deduction under section 80LA for business income. So friends, this is a summary of the tax implications for Cat 1 and 2 of AIF. So where you are located in domestic tariff area, nature is business income. Cat 1, Cat 2, taxable. IFSC, located in IFSC, Cat 1, Cat 2, nature of income is business. Taxable, but you get a deduction at ATLA. Okay. In the hands of unit holders, everything is exempt under 1023 FBG. Again, where you are located in domestic tariff area, you have other than business income, exempt under 1023 FBA. In the hands of the unit holder, it is taxable. For IFSC, again, same treatment, no change, because IFSC ATLA deduction is only available for business income. It is not available for other than business income. Similarly, for Cat 3 AIF, if you have a capital gains income from domestic area, then it is taxable, as we saw earlier, that for Cat 3 there is no pass-through status, it's taxable at the fund level itself. Because it is taxed at fund level, it is exempt in the hands of the unit holder, so it's exempt in the hands of the unit holder. If it's located in IFSC, it is exempt, capital gains is exempt, provided it is covered in section 10(4)(d), and in the hands of the unit holder, it is also exempt, provided it is covered under section 1023 FBC. That is for a Cat 3 specified fund covered under 10(4)(d). If capital gains income is being distributed to the unit holders, it is exempt under 1023 FBC. Any income other than capital gains, domestic tariff area, taxable again at AIF level, and because it is taxed at AIF level, there can't be double taxation as a unit holder, so it's exempt in the hand of the unit holder. Cat 3 Aif, earning other than capital gains income set up in IFSC. Its income is taxable because other than capital gains will be your business income, so it will be covered under ETLA. So it is taxable but subject to deduction under ETLA. And in the hands of the unit holder, it is exempt under Section 1023 FBC. So if you look at it, friends, there is a tax arbitrage available if you have a Cat 3 AIF located in IFSC on your business income, because a Cat 3 AIF not in AIF, sorry, Cat 3 AIF not in IFSC will have to pay tax on its business income and exempt in the hands of the unit holder. Cat 3 AIF located in IFSC will not have to pay tax on its business income because it will get a reduction by ETLA, and resultant income is exempt in the hands of the unit holders. There is this tax arbitrage available. Now, what are the TDS implications on distribution of income by AIF? So Cat 1, Cat 2 AIF, if there is a business income, no TDS applicable. Other than business income, for resident 10%, for non-resident rates in force. For Cat 3 AIF, be it business income or other than business income, TDS does not apply because as we saw earlier, Cat 3 AIF are taxed at that fund level and not at the investor level. So if it's taxed at a fund level, you can't have a separate TDS or a separate taxability again at the investor level. Now, this is another aspect which government is focusing on, which is relocation of offshore fund to the gift city. So let's say you had an existing fund which was operating. Okay, now it is possible that that existing offshore fund, so non-resident investor was investing in offshore fund, and through offshore fund you had Indian investing entities. SEBI in 2021 issued a circular for allowing off-market one-time transfer of securities by an FPI existing foreign portfolio investor to a Cat 3 AIF located in IFSC. So let's say you have a foreign portfolio investor who has already invested into India. He is holding securities in Indian companies. Now he wants to set up an operation in AIF. So he will set up a Cat 3 AIF in IFSC, and all his existing shares will be transferred to this AIF located in IFSC. In that case, because it's a transfer of shares, ideally capital gains applies, but under the law, they have given a specific exemption that there will not be any transfer, any capital gains if there is a relocation of fund from offshore fund to resulting fund. Similarly, in the hands of the unit holders, because earlier there was a foreign portfolio investor, above it there would be unit holders who would have invested in FPI, and FPI in turn would have invested in India. Now that FPI, once you know that FPI relocates to India, gift city AIF, okay, at the Cat 3, then there will be a swap. So their units in the FPI will be extinguished, and the AIF will directly issue units, its units, Cat 3 units, to the non-resident investor who had invested in the FPI. In that situation, whatever is the capital gains, that also is exempt from tax under Section 47(7)(a)(d). So basically, whenever you are moving an offshore fund to India, IFSC, the Cat 3 AIF, it is exempt at both the levels, at the fund level also, because of the transfer of securities, it is exempt, as well as the unit holders, because they cease to be unit holders in the FPI, but now they will be unit holders in the Cat 3 AIF located in IFSC. So at both the levels, no tax is applicable. Government wants them to do this. So this is just a comparative analysis of different type of income which you can earn in offshore jurisdiction vis-a-vis the IFSC. So first, let's say capital gains on sale of equity shares in India, taxable in all the cases. Capital gains on sale of other securities like derivatives, bonds, AIF, etc. Singapore, Mauritius exempt, IFSC exempt provided it is counted 1040, that is all its shareholders are non-resident investors, and it fulfills the conditions of convertible foreign exchange prescribed under 10(4)(d). Tax on interest from G section qualifying bonds 5% for Mauritius, 5% for Singapore, and 10 or 5% if 194LD applies. And tax on interest from other securities, 15 or 7.5 in Mauritius. In IFSC, it will be 10%. And dividend 15% for Singapore, Mauritius, and 10% for India, provided it's a Cat 3 Aif specified under 1043D, or 0%, provided it is Cat 1 or Cat 2 AIF. So basically, if you look at it, friends, what they want is they have given IFSC, they have given in a way that they want to match the financial regulatory or the tax which is there currently prevailing in Singapore and Mauritius. So they are encouraging more and more companies to set up operations in IFSC. Portfolio manager. Now, if they want a fund to be set up in IFSC, naturally portfolio manager will follow because both will go hand in hand. Now, there was a small anomaly in the act with regards to portfolio management. What the existing provided is that taxation of non-residents on receipt whenever portfolio manager receives any remittance from outside India or invest in an offshore securities through a portfolio manager, income earned from such foreign securities is taxable in India because the receipt is in India. So under the existing law, there are three conditions which you need to fulfill for an income to be taxable. A, it can be either received in India, or it can be accrued in India or arising in India. And third, or income can be deemed to accrue or arise in India. So if any of these three conditions are satisfied, correct, ideally the income is taxable in India. Now, when a non-resident invests in an offshore security through a portfolio manager in IFSC, then income earned from such foreign securities ideally becomes taxable in India only because the receipt is in India. So to remove this anomaly, in this year's budget, they have proposed that income of a non-resident from portfolio managed or administered by portfolio manager in IFSC on behalf of such non-resident in an account maintained with offshore banking unit is exempt from tax, and to the extent that such income accrues or arises in India. So once that is portfolio management earns this income, then it is exempt. This anomaly has been rectified in this year's finance bill. One more interesting business opportunity is for shipping and leasing companies. Now, this is a typical model where you will have a lessor, okay, be it a foreign entity or be it a unit located in IFSC, and they will give the ship or aircraft on lease to an Indian lessee. So a typical model is IFSC unit, let's say, buys or operates on lease an aircraft or ship from foreign entity that is engaged into leasing business with Indian entities. So IFSC unit in turn is giving aircraft or ship on lease to foreign entities. IFSC in turn will make payment of lease rental to foreign entities and will receive the payment from the lessee. Now, lease can either be an operating lease or finance lease. Now, what would be the tax implications? So first, whenever an Indian lessee is using this aircraft or ship for lease and is making the payment of lease rental, it will be subjected to TDS at a normal rates. Under the existing provision of Income Tax Act, any payment to IFSC by India is not subjected to any different tax rates. All tax rates, TDS rates are same as before, so no change. Second, leasing income of IFSC. So now first level is over. Indian entity, as let's say this Indian lessee, has paid or made payment to IFSC. In that case, first and foremost, no TDS for Indian lessee. So that thing is very clear. Sorry, TDS is applicable at the applicable rates. Second, whatever is the income of IFSC, because IFSC will earn leasing income. So whatever income is earned by IFSC, along with the capital gains income, if at all arising on sale of ship or aircraft, will be subject to deduction at TLA, which will result into a tax blockage for IFSC unit. So as far as IFSC unit is concerned, there will be a tax blockage point. Depreciation on aircraft or aircraft engine is now eligible for 40% depreciation, so you get an accelerated depreciation. Now, we'll go a level above. So that is payment of interest or royalty by IFSC unit to foreign entities. So we are now at this level, foreign unit to foreign entity. Now in that case, any payment of interest or royalty by FSC unit to foreign entities is exempt from tax in the hands of the foreign entities. So whenever that IFC unit is making payment of interest or royalty, that is also exempt from tax. So whenever IFSC is making payment to foreign entities for interest or royalty, no TDS is to be deducted. Now these exemptions are subject to unit commencing operations in IFSC before 31st March 2024. So if you are covered under this provisions, you have commenced operations before 31st March 2024, then these exemptions are available. But what happens is that because there is no tax at an IFSC level, TDS deducted by Indian entities will be subjected to tax blockage at an IFSC level. So there is a slight anomaly because income of IFSC is exempt under or is subject to deduction by ATLA. So I said there is no tax liability payable by IFSC unit. But when he receives income, lease rental income from the entity, the TDS is deducted by the Indian entity, not subjected to any different rates. And because it is deducted, that entire amount has to be claimed as a refund, resulting into tax blockage at a IFSC level for some period. Now, typically, friends, there are one more option which is prevalent is the common market. So, when you compare the structure with other Ireland or IFSC, if you look at it, then payment of lease rental not subject to TDS under Article 8 or 12 or 13 of India Ireland Treaty. In IFSC, TDS is applicable. Second, in the hands of the lessor, he will receive lease rental and capital gains. Under India Ireland, not taxable in India, and in Ireland, you have preferential tax rate. If you are receiving in IFSC, then entire income of lease rental and capital gains is eligible for deduction under ETLA. Third, payment of interest royalty by lessor and non-resident entity not subject to any TDS in India. So whenever interest or royalty payment is made by lessor to a non-resident entity, no TDS is applicable, be it under the India Ireland or be it under the India IFSC. And non-resident entities income, so it's exempt under India Ireland as well as it's exempt under the IFSC. So by and large, the government has tried to ensure that this ship leasing or aircraft leasing activity is successfully completed, because this ship leasing currently is being undertaken through Ireland or through any other jurisdiction or Mauritius. Government wants that entire business to be shifted to IFSC. That will also give impetus to the next level of businesses in Gujarat or GIFT City. And with this, friends, I think this is the last slide, that there is an exemption which is provided from obtaining PAN under Rule 115AA. What it says is that if a non-resident is an eligible foreign investor, is not required to obtain PAN, provided he has only done transactions specified in 47(6)(ab). Second, name and email of the contact number, address, declaration, and tax identification number. So if you furnish all this information, foreign investor who has invested in Three Aif located in IFSC is not required to obtain PAN, but is required to furnish all these details to stockbroker within 15 days from the end of the quarter of each financial year. An NRI or a non-resident investor having income only from specified funds is subject to submission of above mentioned information in Form 49BA to department. So there is an exemption provided under the law. You need to submit it in advance. So whatever is the non-resident investor having income from specified funds, not subject to TDS, not subjected to PAN requirement. So with this, friends, I think we have come to the end of what are the tax benefits which are available to IFSC. And I think we have around 15-20 minutes of time. So we can take few questions if anyone has. So Swati, should we take on the questions?
Now, Swati is, I think, missing. I think she's not here. I will help you to take the questions.
Sure. Tell me.
First question is payment made by Indian party to any foreign vendor who has bank account in GIFT IBU of Indian bank or foreign branch.
Okay. So what is the question? Such receipt will be considered as income deemed to receipt. Yes, that is right. Benefit of DTAA is available to foreign taxpayer. So as we saw earlier, that whenever an Indian company is making a payment to a vendor, foreign vendor, if it is in relation to those kind of income which is specified under section 10(4)(d) or under any of the earlier sections what we saw, then TDS is not applicable. Otherwise, TDS is applicable at the normal rates.
Second question is depreciation in tax holiday period will be carried forward as unabsorbed depreciation.
Yes, that is how it will be considered, because unlike 10AA or 80IA where you had a specific provision, here 80LA there is a specific provision. So ideally it would be carried forward as unabsorbed depreciation. I'm sorry, I think I stand corrected here. Depreciation, whatever is there, okay, if you have there is a loss, so let's say there is an unabsorbed depreciation in the tax holiday period, you will not be eligible to claim reduction under 80LA, because under section 80 overall, what it says that all deductions under chapter 6A cannot exceed your GTI. So if your GTI is 0 or negative, assuming you have unabsorbed depreciation, you will not get any deduction under 80LA. So technically this question will not arise because you will not have unabsorbed depreciation.
Next question is relaxation in prohibitory conditions with respect to depreciation, amalgamation or demerger are intentionally given or just initial loopholes? Is there any chance of future restrictions?
So it is difficult for me to comment on what is the I would say the intention of the legislature. My understanding is it may be a drafting error and they would correct it, but principally it will always be an amalgamated company or resulting company who will be eligible for claiming a deduction. So you can't have deduction being claimed in both the companies, amalgamating and amalgamated. That I don't think should be is allowed.
Next question is which provisions or sections of the IT Act provides the exemption to category 1 and 2 of AIF?
So there are 1023 FB and other sections which I have already reproduced in the slide deck, which provides for exemption for category 1 and 2 AIF.
Now, regarding the real estate investment trusts, they are asking whether it can be set up in IFSC.
Yes, definitely. So
can foreign subsidiary of Indian holding company can set up step down subsidiaries in IFSC? Can it be considered as round tripping of fund?
Okay, see, let's understand one thing, that when you are setting up an operations or when you are setting up a company in IFSC, it is considered an overseas direct investment because IFSC is an ODI. Now, if an Indian company has set up a company in, let's say, USA, which is a foreign company, a foreign subsidiary of Indian holding company, below USA, you want to set up a company in IFSC. Okay, now what will that IFSC company do? Because IFSC company cannot transact with any other Indian company. It can only transact with IFSC units, or it can transact with persons resident outside India, or let's say foreign companies. So technically the funds are never going to come to India. So I don't think this could be considered as a round tripping of funds. But be that it may be, it's better to take a clarification. And I think yesterday was the best speaker, Kamlesh Sharma ji, to answer this question.
Can shipping company in IFSC apply for exemption under section 172?
Definitely. So I think shipping company will also be covered under IFSC and it can apply for exemption under section 172.
I think that is all, because the last question, it is a very question. I don't think it will be possible for us to disclose on who is registered and who is not.
Correct.
So that sums up the session. A wonderful session by CA Saumya Sheth. Is the chairman there? Yes, chairman. Please unmute. Chairman, please unmute yourself. Chairman, please unmute yourself.
Chairman is not able to unmute.
Is Mayank there?
Yes, sir. I'm there.
Mayank, can you close by giving a
Yeah, sir, I can now
vote of
say
thanks?
they were not. I think they were not
Yes, sir,
allowing me to
definitely.
speak. I think I still have a few days to go as a chairman. I think they were just not allowing me to unmute. But I think thank you so much, Saumya. Excellent session. I think as usual, you were brilliant in whatever stuff you deliver. I think be it income tax or FEMA or any other law for the time being. Thank you, Saumya, for always being there for the session. And I think we have Mayank ji who will give us a vote of thanks. So on behalf of Mayank ji, if we can, on behalf of all of us, we can give a vote of thanks to Saumya.
Yes, definitely. Thanks, Harijji and Rajendra Nagar, sir, for giving me this opportunity. I would like to convey our sincere thanks to CA Saumya Sheth for such an enlightening and enriching session on income tax implications for setting up and doing business in GIFT IFSC, or specifically give more perspective on from shipping and AI funds. Further, I would like to add that your remarkable depth of understanding of this subject will make that lecture an exponentially stimulating and informative one. With this, I will end my vote of thanks. Thank you once again, sir, for your time and for such a wonderful session.
Thank you. Thank you for having me here and look forward to further interesting sessions.
Yeah.
Thank
Thanks a
you,
lot,
thank
sir.
you, thank you,
Thank you.
Saumya. Thank you so much. Thank you, Mayank, for the vote of thanks.
Thank you, sir.
Thank you, sir. Thank you.
Thank you.
We will close the session. Thank you,
Tomorrow
all, everybody, all
tomorrow
the
we'll meet
participants.
for the last session for this GIFT City series on
Yeah.
this opportunity for inbound and outbound investment and AIF regulations, specifically.
Yes. Thank you to participants. See you tomorrow.